So the mission of the National Black MBA Association is to lead in the creation of economic, educational, wealth building, and growth opportunities for those historically underrepresented throughout their careers as entrepreneurs and professionals. So those are the constituents that we serve, all the way from high school students within our Leaders of Tomorrow mentoring program, entrepreneurs, as well as professionals, both early career professionals all the way through those that are experienced professionals and even retirement. So we have 40 chapters nationwide. Our local chapter has roughly 175 plus members. We have about 25 programs throughout the year, and we service the 5 central counties throughout the Central Florida area. This is our current executive board for the Central Florida chapter. So again, my name is Kimberly Saunders, and on behalf of all of our board members, we thank you for joining us this evening. So for the next hour and 15 minutes, we welcome our partner, Charles Schwab, who's actually been a partner with us. This is the 3rd year, and every April around Financial Literacy Month, we try to work together to provide a financial literacy, whether it's one event. This is the first year we're doing a 3-part series just because of the topic and the information that we would like to provide. So definitely want to thank Charles Schwab. And just a little bit about Charles Schwab for those of you that may not know of them. They offer investors a contemporary full-service approach to build and manage their investments, providing investment-related products, services, and sophisticated financial planning that combine the best of what people and technology have to offer. And their slogan is "Own Your Tomorrow." And they are absolutely a great company. They have a lot of service offerings that assist anyone with, depending on where you are with regards to where you are throughout your career and throughout your wealth building process. So I definitely encourage you to take a look at Charles Schwab, go on their website, schwab.com, and all of the tools and resources that they have available. So tonight, this is our lineup. It is part 1, and we are going to be talking about what is comprehensive financial planning, debt flow cash management, risk and insurance management. And again, as mentioned, we want this to be very interactive, so we hope that you all have your questions prepared so that we can get those answered for you. What I'm going to do now is I'm going to introduce our 2 panelists for this evening. And then I probably will do them a disservice, so I'm going to allow them to tell a little bit about their backgrounds and their credentials and what they do throughout their professional career so that you become more familiar with them. So the first panelist that I'm going to introduce to you will be Miss Christine Maskell, and she is a private client advisor with Charles Schwab. Christine, I'll allow you to introduce yourself.
Mute here. Thank you so much, Kimberly. So thank you for everyone for joining. I know it's been a long day, so glad you're here and glad to be here as well to be a part of this. As Kimberly said, my name is Christine Maskell. I am a private client advisor with Schwab Private Client Investment Advisory, and we are an affiliate, the registered investment advisory affiliate of Charles Schwab and Company. I am located in Orlando, Florida, and have been with the firm now for almost 11 years. This August will be my 11th year. I've navigated through a few roles at the time with the firm, and of course, found my final destination in the private client area at the end of 2014. I do partner with clients, ultra high net worth and high net worth clients, to help them in a holistic nature to meet their financial and personal goals, regardless of where they are in terms of the stage of their life. And I really enjoy doing this because it really gives me an opportunity to make a change or to make a difference in the lives of the clients that I do work with. I am a certified financial planner. I also do hold a certified wealth strategist designation, and I also have a master's in personal financial planning. All these things just allow me to work with clients, whether complex or non-complex issues, as they continue throughout the different phases of their life. So that's just a little bit about me.
All right, Christine, that was beautiful. Thank you so much for sharing your story with us. My name is Dr. Kimberly Turner. I have a PhD in retirement planning and financial planning. I'm also an adjunct faculty at the American College and with California Lutheran University. At the colleges and university, I teach graduate level courses in financial planning and retirement planning, and I really enjoy teaching. I'm also the owner of Retirement Planning Doctors. I specialize in helping doctors build retirement. I show them how to create a sustainable, safe, and secure retirement income. In addition to physicians, I work with women in transition and small business owners. That's my sweet spot. I really like helping people build wealth. I'm reminded of a story. When I was young, my mom often would remind us that we were not financially rich, but we were rich in love and that we were very happy. My mom raised 4 children by herself, and it was very difficult. And we really did experience a lot of financial challenges at the time. And I would often tell my mom, I understand that being rich with love is good and is important, but one day I want to be rich financially as well. And so I set out on this course. I thought initially I was going to be a model, and then I thought I was going to be a movie star and live in a big house. And that didn't happen. I actually was able to acquire my wealth through real estate, insurance, and financial investments. And I'm so happy that not only was I able to do that for myself, but I've helped so many people along the way. I got into the financial industry back in 1998. I started out as a real estate developer. Then I owned several real estate companies. And then I obtained my mortgage broker's license. So I helped with financing of the homes. And I wanted to do the closing. So I got my title license and opened up a title insurance agency. So at that particular point in time, everything that I knew and every avenue that I was helping individuals was real estate. And then 2008 hit, and you all know what happened during the Great Recession. Because we were just so heavily loaded in real estate, we really took a beating. But, just like everyone else, I just, put my shoes back on and say, look, I'm going to just reinvent myself. I'm going to study it. I'm going to do something different. And then that's when I started studying the other capital markets and understanding the importance of diversification and looking at the other assets in the financial industry when it came to securities. So I worked at Morgan Stanley for a while when I started. Then I worked with MetLife. I've also been with PNC Bank. I've been with Allstate. And now I'm just a registered investment advisor. I'm a fiduciary. I try to support and help my clients the best way that I can. And I'm advice-based, fee-based, and it's been wonderful. And it's been such a blessing to be able to help so many families just to become a little healthier, a little wealthier, and a little wiser along the way. Thank you, Kimberly.
Thank you so much to the both of you for that introduction. So before we get into the good stuff, I do want to let you all know if you do have any questions while any of the panelists are providing information, I would ask 2 things. So if you'd like to ask that question verbally, if you could just raise your hand and we will make sure that we call on you. Sometimes verbalizing answer to some people works better. Or you can also type it in the chat box and we will be monitoring the chat box. So we'll make sure that the question gets answered in that form or fashion. So 2 ways, you can raise your hand and we will call on you, or in the chat box and we'll make sure that we get that question answered. So I will share one video. It's very short, about 30 seconds, and then we're going to get started with the first question.
We would study our competitors very, very carefully. Ameritrade kept us fresh, kept us ambitious. Both companies had our freedom to take care of individual investors. It's really about helping people The combination today is historic, an unbelievable fortress of a company with the highest level of integrity. That's who we are.
Okay. So that is Charles Schwab. They truly are an amazing company. And we once again thank them for the opportunity. And once again, still playing there. So we just want to thank them again for their 3-year partnership with the National Black MBA Association, Central Florida. And with that being said, we are going to get started with part 1. And so we're going to start off with Christine and tell us a little bit about what is comprehensive financial planning. We all sometimes will focus on 1 or 2 areas, basic information, basic planning. But at some point in life, right, we're going to encounter all of them, and we need to know how all of them work together and truly make a sound financial plan. So what is comprehensive planning? What do we need to know about it, and what does it entail?
Absolutely, great questions. So at Schwab, we believe in the foundation of having a financial plan. Studies have shown that people who prepare proactively do usually meet their goals, or at least are more confident as they move into retirement. Within Schwab Private Client, we do have several options, as you mentioned, Kimberly, where we can do just itemized or just small planning topics. Say, for example, Social Security optimization. We can help with education planning, risk management, just the different areas that we find to be most impactful to the clients that we serve. And we do know that not everyone will have the same issues, because each person is so unique, and that's why it's important to have a plan. What does that mean, and how does that, how is that important in regards to financial planning? So comprehensive planning is just to look at the self as a whole. So with some clients, we find that people will have diversification across firms, diversification across advisors. That can sometimes bring unnecessary risk. The risk that can bring, inappropriate allocation, possibly just not being able to coordinate assets. And then number 3, you're also trying to manage your advisors as well. So that's why it's important to have a financial plan in place. Number 1, you'll get to define and highlight your current situation. You'll also be able to determine where there are any gaps. And then, of course, you'll actually have goals in place. And that's why it's really important. The first step is, of course, understanding what your goals are. So to start the planning process, it does require being realistic. Don't set goals that you can't realize, maybe unattainable, and you should write your goals down. That's something that I find to be most important for the clients that I partner with, is what are you looking to achieve? Many clients don't know the answer to that question. They know they have this sum of money, whether it's received through earned income or whether it's received through inheritance or a small business. They just don't know what to do with it. And that's really important, because our goal as financial planners is really to help you to understand what are your limitations, what are you planning for, what are you scared of. That way we can help you to identify, prioritize, and even quantify those specific goals. With comprehensive financial planning, we will recommend that you update your plan at least annually. And the reason we do that is things change, right? As much as we like them to stay the same, we all know that priorities can change, goals can change, your life can change, and that's why it's really important. Outside of just the annual updates, it's really important to make changes to your financial plan as your life and as your circumstances change. So say, for example, you get divorced, maybe you get married, maybe you have a baby. This might require insurance, maybe a change to your estate plan, maybe educational funding. Your tax situation may change. And that's why it's really important just to ensure that you're staying on track, and why you should write your goals down, just to ensure that you have a way in which to manage those goals, and that, of course, you're continuing to meet those over time. So that's in a nutshell, what financial planning is. There are many different aspects and facets of financial planning. A comprehensive plan will include an inventory of your assets, your liabilities, any type of goals you have for the future. We will also look at insurance, any other banking or credit needs. And we, of course, want to help you to prioritize, because if there's a gap, then maybe we can help you to either save more, maybe you can work longer, maybe there is something that you can do to improve your cash flow. And of course, this is what we'll do next. We have other presenters this week that will, of course, deep dive into some of the other wealth management issues. And today I will focus on debt and cash flow management. Any questions or anything else that I should stop for, Kimberly? Or should I keep going?
Thank you so much. I was going to ask Dr. Turner, do you have anything to add to that?
Christina, you did a wonderful job giving us the overview of what a comprehensive financial plan is. The only other thing that I would like to add to that is that you decide what your goals are. We as financial planners, we just help you to articulate, to have a better idea, to clarify what your goals are, and to help set a roadmap in the most expeditious way possible to get you there. So these are your own goals, and we just kind of create that roadmap for you to reach your goals. And also your goals could be short-term or they could be long-term, but they're your goals. And we just set up a plan that is going to help you accomplish them in the time frame that you want. So that's the only thing I would like to add.
Thank you so much. So we're going to get into the first step, right? So debt or the first level of this, debt and cash flow management. So tell us a little bit about what goes into managing your debt and cash flows. Why is that usually one of the first areas that you will cover in order for all of the other areas to flow thereafter?
Great question. So managing your debt is really essentially the foundation, right? So before you can save, before you can invest, you want to make sure that your debt load is manageable. If you're not able to pay your bills or your expenses and you have a negative cash flow, meaning you have to borrow to live or to pay your essential expenses each month, then how are you going to afford to be able to save? And that's why it's important to look at your assets, to create a budget, to create a plan. That way you can, of course, move into the other areas of your financial life as you start to accumulate assets, and then, of course, growing that wealth before you can start preserving and distributing that over your lifetime.
Awesome. Dr. Turner, any additions to that?
I would just like to add, that was really good, Christine. Budgeting. There are many different ways to budget. Through my experiences, there's like 4 different budgeting strategies. And I think that one budget strategy may not work for the next person. And so in order to determine which budgeting strategy works for you, it's important to know what your personality style is. And once that is determined, then we could recommend which budget is going to be appropriate for you. A lot of times, personally, I started out doing the cash envelope budgeting strategy plan, and I didn't really like that particular budgeting plan. So I really like going to the saving first plan. That really helps me. So I just identify that I want to save 20 to 25% of my income that I bring in, and then everything else falls into place. That works for me because it allows me to have more freedom. The envelope budgeting strategy didn't work because number one, I was always sort of like, opening up my envelopes and there was no more cash in my envelopes when I went to the grocery store, and I was having to pull from something else. So that didn't really work. But now there's a lot of different budgeting tools that are out there that are more online and technology driven, that maybe if I would have ventured back doing that particular strategy, I could, but I just absolutely love the saving first strategy when it comes to budgeting. So in a nutshell, budgeting, we know is difficult. It's something that people do not like to do because they feel like they're restricted and they feel like there's limitations that are around that. However, if it's done properly, budgeting, just like Christine said, is the foundation for a financial plan, because without budgeting and not knowing where your money is allocated, then your money will continue to just, filter through. You'll continue to lose it. But you must identify everything that's coming in so you have a better understanding of what's going out, so you can have a better plan to build your wealth. Thank you.
Thank you so much. And I think it's very important that we understand a couple of things there, that it's personal to you, right? Your plan is personal. It's no one size fits all, and there's no right one path here. So we want to make sure that, you all understand that this is a personal, it's personalized, specific to your situations. Now, just to get you all involved a little bit, I'd like to just ask a couple questions. You all can type in the chat. Since we're talking about budgeting and debt management, are there any apps or any websites that you all utilize to help with your budgeting process? I know a lot of banks, right, our financial institutions will have some type of software that assists us with that. But what are you all using? Because I find a lot of times when we share, maybe someone on the line may not know of different apps or other apps that may be utilized. But what are some software programs or apps that you all utilize to help manage your debt and cash flow? So you can just type that in the chat so that way we can get that going a little bit. Okay, I see every dollar. Okay, so while we're doing that, Christine, what gaps do you often notice, or what are things that you often find that we overlook when it comes to debt planning and cash flow management? I know that, there's so much information out there, and we kind of usually stick to the basics, stick to kind of what we know. I know that personal budgets and even, budgets of others, we kind of say, okay, our rent or mortgage, utilities, but there's some areas that we miss. And I know that you all will kind of have second eyes, and you can catch certain things that we don't think about. So when we're putting together a budget or a spending plan, as a lot of people like to call it, right? It's less scary. It's overlooked for a lot of your clients.
And, it's very interesting. Sometimes people will say, well, you work with high net worth clients. What do you mean they need a budget? You would be surprised. A dollar is a dollar at every level. And, clients that have more wealth still have challenges, right, with sticking to their budgets, with ensuring they have appropriate cash flow. And this is why we say write it down. If you don't know how much you're spending each month, you need to write it down. There are, of course, many electronic formats. There is the pen and paper format. Banks will do that as well. Some of the main things that we find is, number one, not having a budget, so not knowing how much you spend each month versus how much you're earning. Number two, another gap that we find is not breaking apart your expenditures for essentials and non-essentials. So it is very important to understand, what is it that I can't live without? Likely your light, your water, your groceries. These are essential expenditures. And then the non-essentials, getting my nails done. I really like doing that. But, from time to time, clients overlook that, especially as we try to plan. And in some cases, if a plan falls short of the success that we were looking for, that we were anticipating, it makes sense to separate these two, because then you can say, okay, these are my essentials. I have to have money to meet these. These are my non-essentials. Maybe I can scale back in some of these areas to ensure that I can meet my, my financial goals. And to what Dr. Turner mentioned as well, the saving aspect of it. Sometimes once you've put the budget together, how do you separate to find, how do I start, my emergency fund? Because once you have a budget, you'll know how much is coming in, you know exactly how much is going out, whether it's essential, whether it's non-essential. And then your next step is, maybe I should start an emergency reserve. And that's where we find that some clients don't consider, because we all think, oh, it's one bucket, just put everything in one bucket. But with the emergency reserve, that should be liquid. It should be accessible. And, the pandemic has shown us that it's very important to make that consideration, because it can happen just like that, where you'll actually need to tap into that.
So you did mention something there. You mentioned, the savings component, right? Can you speak a little bit? I know we have investing coming up next week, but
Yeah.
sometimes people think that they're one and the same, right? So savings versus investing and why there should be a differentiation there.
Absolutely. So the differentiation in terms of the emergency fund and saving. So before you can start investing, you want to make sure that your debt is manageable. And I always like to remind people, all debt is not bad. When borrowing, you want to meet goals, right? But we have to always consider both sides of the balance sheet. So when you're saving, you're trying to either pay down or reduce or even eliminate debt. You're trying to ensure that if you have any excess outside of, the other things that you like to do outside of your essentials, that you're putting away 3 to 6 months to meet any type of emergencies. As we saw last year, many people got laid off unexpectedly, and that's where saving is important. Because if you go out and say, okay, let me invest my emergency fund, we can all see what can happen. If you have to sell in a down market, you have a problem. Your emergency fund should be liquid, cash or cash-like instruments. And while we can't make specific recommendations because each person's situation is unique, it is important to consider that your saving is really for something that's important, something that you've prioritized, and your saving will be different based on the time horizon of the goal that you're looking to achieve.
Awesome. Thank you so much. So just a couple of questions to the audiences if you all want to comment on this. But there were a couple people that wrote down different apps or software programs that they used for their budgeting and cash flow management. So are there any difficulties or roadblocks or even limitations that you all have seen, throughout your years in trying to budget? Or on the opposite end, what do you find has been working for you? So I'd like to also, allow for us to share some of that information. So either one, if there's any difficulties or roadblocks that you all may have seen in your respective application, or if you have successes, if you'd like to share those or share some of the benefits of some of the programs that you use. Would anyone like to share?
I guess I can maybe share real quick. So
Sure.
my wife and I, we actually, I guess, as we're trying to schedule and do budgets together, we went through like the Dave Ramsey Financial Peace University. So we really put pen to paper, so to speak, or really just did like Excel spreadsheets to kind of, and then had like monthly, actually bi-weekly meetings that we would discuss what expenditures are coming out and going in. So we kind of did it, I guess you say, the old school way. And now that we've done it for a little while, I think now we're ready to transition into something like QuickBooks or something like that, but we haven't figured out what that is. But for us, just the Excel spreadsheet worked, but it can be cumbersome, when you're trying to go back through bank statements and figure out, all the different charges that you've had from debit cards or whatever. So I'm sure there's better ways to do it, but sometimes just doing it in a tangible way, I think it means something. It meant something for us first to do it that way first, and then we can implement some other more automated way to do it. So
Awesome. Thank you for sharing. So actually, that'll lead to my next question to Christine, and then I'll come to you, Dr. Turner. So Eric mentioned that, so he's married and him and his wife they're planning together. So I also know that there's different thoughts of this, and it also depends on the client, right? So there are some clients, of course, that are single, but then those who have partnerships may still want to do their separate. So any information or guidance that you could provide on what may be maybe the most appropriate in that situation where there may be two individuals who are in the household together, they're partners, and they may still choose to do their planning separate. So what are the pros and cons of doing it together versus, doing it separate?
The first thing that I would like to say, the person who spends the most, you have to put a lock on that back door. I've had clients come in and join me on the phone, and they just start going at each other. And I just sit there because you can't choose a side. So it definitely happens. It's very unique, right, for each couple, for each family. I've seen it both ways, where we have individual savers, maybe one person spends a little more than the other. The comfort is that we have a joint bank account for joint expenses. I have mine, you have yours, or we have everything separate, and then we just come together to pay bills. So as long as you're both on the same page, right, I think that's important. And just communicating, because there's nothing worse than sleeping next to somebody if you can't trust them with money. And there's nothing scarier when you're working very hard to provide for your family, to save for your future, to save for your retirement. If you just see that money going out the back door, you probably look at your statements. So just find what works for you. You'll have conversations. And I've heard people judge others, right, that have separate accounts and save separately, or, you know, the ones that save together. If it works for them, it works for them. But of course, just communicating, knowing exactly what you both agree upon in regards to what are we going to pay together? What expenses are we going to share? What are you responsible for? What am I responsible for? How much are you bringing in? It's always important in any budgeting conversation. We all have to know how much is going in the pot. So we have to know, what are you bringing in? What am I taking home? What percentage of the bills do we share? What do you pay? And at the end of the day, if we have any excesses, where do we put this? Of course, we're naturally going to say, regardless of how you decide to share those, that load or that burden, just ensure that you're saving after you have excess. And I always like to say, listen, I will be the last one to tell you to save every penny, because I'm human as well. And, you know, I have things that I like, but I always say, I pay my bank account first. I have several accounts that I have my direct deposits go into, and I have funds that automatically transfer to saving accounts. And the reason is, if I don't see it, I don't care. I won't miss it. But if I see it, then, you know, I might see something that I like. I might get something pop up from Nordstrom, and I'll be like, oh, maybe I should get that. So it's just important to communicate. That way you can kind of, you know, stop those gaps if they are identified.
Great, thank you. Dr. Turner, do you have anything to add to that with regards to planning together for partnerships?
That was really good, Christine. I would just like to add this. I think it's important for clients to understand that they have a choice. They could choose to do it jointly, separately, or both. And I think once they understand that, then I feel like I'm a good fiduciary. Because so many times I have found, especially the women, they don't understand that they have the right to say, okay, I just want to do my own thing, you know, and I want to do it with my husband as well. So sometimes you would end up doing 3 different financial plans, one for the husband, one for the wife, and then a joint. And that's just how things are. And I think once they understand that, that makes them feel more comfortable. So that's what I would like to add.
I think that's very important, right? That goes back to a customized plan. So you don't just have to have one, you could have as many as 3, if that's what's needed. So that's really good to know. So I'd like to open it up for any questions on the debt or cash flow management component before we talk a little bit about the insurance planning. Does anyone have any questions? I'll hold for about 5 seconds before we move on. And for those of you that maybe joined us within the last 10 minutes or so, this is interactive. So if you have any questions, you may raise your hand and we can call on you if you'd like to verbalize the question, or you can always type it in the chat box and we'll make sure that we get to it. So tonight we're covering comprehensive planning, debt and cash flow management, as well as insurance and risk management. Okay.
Excuse me, Kimberly, that's only one thing else I would like to add. I
Sure.
just remembered this. A lot of people get intimidated when we talk about the emergency fund. And as Christine said, typically it's going to be 3 to 6 months is what you want to allocate for. But I have found that if you just do a smaller bite, if you say, look, if I'm going to try to put $500 away for my emergency fund. And then once that has been, achieve, then you can say, now I'm going to aim for $1,000. I think that it's important to just look at things, in a bite-sized portion, because that'll give you the momentum to keep going. So I just want to throw that out there. So people really have a hard time saving 3 to 6 months, but $500 in your emergency fund, we can pretty much do that within a year, and then try to, build from that. Thank you.
Sure, and I think it's important. So I always say, even though we are the National Black MBA Association, we're an organization of professionals at all stages of their career. But it's also important to know that regardless of whether you had an entry level position or you were, had a VP level position and making, substantial income, that we've all probably had moments, or we could possibly have moments if we haven't had them yet, where we may fall short, right? Last year was a tough year for a lot of people. Alternatively, it was a great year for a lot of people. So we make sure that we are understanding all aspects, regardless of where we are, because we never know where we could be. Okay. And so one of the things that we'll get to now is the insurance and risk management. It's not the sexy stuff, right? Everyone wants to get into the investment planning and retirement planning, and but it's important to understand the risk and insurance planning also. And I will add this caveat, because one thing that we don't talk a lot about, especially in our community, right, is the protection component, right? We want to know about, how can I get money in a month, right? How can you give me 5 times my return in 2 weeks? And you're like, well, how does that happen? Well, it's been happening. So that's why the conversation is taking place, especially the last 12 months. It's like you put some money somewhere and next week it doubled, right?
Yeah.
I also want to talk about the protection component. So the risk management and the insurance planning, and why that's important to start with. And that's really, why it's one of the first areas in the comprehensive planning process, because of its importance. So Dr. Turner, if you can, tell us a little bit first about what is risk and insurance planning, and then we'll go a little bit deeper.
Okay, thank you. I would love to do that, Kimberly. So first of all, I think that it's a good idea to try to build as much wealth as you can and to generate as much income as you can. But with that being said, every day you step outside of your home, or maybe being inside your home, all that could be at risk just because of an accident or a lawsuit. I think it is important to not only build the wealth to generate the income, but to protect yourself as much as possible. So not only do I feel like Kimberly said, it is the foundation of a comprehensive financial plan, I think that it takes top priority than any other part of the plan. I could be biased because this is my area of specialty. However, I have seen it over and over again. I'm going to give you an example. I work with a lot of physicians, and physicians, as you know, some of them make more than the average individual. On the average, they probably make anywhere from $250,000 to maybe $500,000 a year, right? So when they're young, they're never are thinking about not being able to generate that income. All of a sudden, somebody, gets hurt. They were in a car accident. Now they're no longer able to practice anymore. So now what happens to that income that they were so used to making, that they had really acquired a lot of debt to pay off their student loans, and they're left with nothing. So just to protect that future income stream is very, very vital, so they can continue to receive what they worked so hard and were so diligent about acquiring the education to practice medicine. So I believe that having a plan to protect your income and your wealth is critical, because you never know what's going to happen. So a personal risk management is a systematic process of identifying, evaluating, and managing pure risk exposed by individuals through various means. When you look at pure risk, it's either going to be considered a loss or no loss. And risk management begins with, I believe, this goes back to what Christine was saying, You have to check out your credit score. You have to figure out if you are credit worthy, because identity theft is real. It's out there. And that's part of a risk. Knowing what your credit score is and having experience. I was the victim of identity theft, and I know how this could really hurt your financial plan. It could hurt your financial outlook in your future. So having your credit report tagged to, if someone tries to go open up credit in your name, or just utilizing your information to ascertain, more debt or more belongings or more material possessions without you knowing it could be detrimental. So I'm going to encourage everyone, as a part of their risk management plan, is to go to receive a free credit report, and once a year evaluate and monitor your credit report to make sure that you're not a victim of identity theft, to make sure everything that's being reported on your credit report is correct. We talked about the importance of setting a budget, because the other risk that you look at is going to be liability management. Am I at risk for having to file bankruptcy? Am I doing things appropriately? So setting the budget and improving your cash flow is really important. And then we can look at some other things when it comes to financial planning and risk management. But I just wanted to make sure that you knew that how cash flow management and credit worthiness kind of fold into this risk management process. So let's talk about the 8 steps to risk management. The first step is to determine your objectives of your risk management plan. So what are your objectives? Are your objectives going to be to minimize your risk based on you taking in and retaining the risk yourself? Is it going to be about you transferring the risk to a third party, like a home warranty company or some type of warranty company? Or would it be you're trying to reduce your risk, your exposure? And so determining the objectives of your risk management plan is going to be the first step, and that's key. The second step is going to be identifying the risk to which you are exposed. And this is what I do when someone comes to me. I was like, okay, let's sit down, let's talk about this. Let's look at all the risks that are out there and identify which ones are going to be more likely the ones that you're going to be faced with. For instance, if you know that cancer runs in your family, let's say 70% of the people who have cancer, chances are you're probably going to have cancer. So then what do we need to do? How do we handle that particular risk? Well, we can handle it in a variety of ways. One way is we can help you purchase critical illness insurance, which covers you and provides you with income if you succumb to cancer. The other thing we want to do, the third step, is we want to evaluate and identify the risk for the probability of occurrence and the severity of a loss. Not all losses are the same. Not all risks are at the same level. I live in Florida. You all know that we in Florida have a lot of hurricanes. That's a very severe risk to be exposed to. So I try to make sure that individuals in Florida, when I look at their homeowners insurance policy, I sort of evaluate, okay, do you understand that if a hurricane hits, if you have a 2% deductible, where's this money coming from? Especially like every 4 to 5 years, it looks like we're having some type of hurricane here. So how are you going to handle this with the deductible being so high? So the severity of the loss is really, really critical. And then determining how are you going to handle the risk? How frequent is the risk? How severe is the risk? And how are you going to handle the risk? When I work with clients, and I think it's really important for you all to do this as well, is look at all of your insurance policies that you have. I think it's critical for you to review your homeowner's policy, your auto policy, your liability policy. whatever insurance policy that you have, even your annuities, review them once a year to make sure that they're going to offer you the coverage and provide you the coverage for what you need. Because things change in life. You may have to increase something or decrease something. And then just sort of looking at what recommendations are going to be more suitable for you, and then implementing the risk management strategies for each risk. And then lastly, monitoring, evaluating, reviewing, and modifying the risk management plan as needed. So there are 8 steps that comprise the risk management process. It's not just purchasing insurance. It's really like identifying what your risks are, the best way to handle the risk, because most people will probably just say, look, I'm okay with having this risk. Or I'm going to retain this risk. I'm going to reduce this risk. I'm going to transfer this risk. And if you identify that, then just figure out what is the best way to do this. Most of the time, it is purchasing insurance. And there are many different risk management tools that are out there when it comes to different types of insurance. So number one, the number one risk that we all hate is an untimely death. So having life insurance will help us financially when we are exposed to untimely death within our family. Unfortunately, when I look at life insurance that individuals have, they typically don't have the right type of life insurance, they don't have the right amount of life insurance, and they don't even have the right kind of life insurance. And that's because they don't really understand what life insurance is all about. Some people look at life insurance purely as if someone dies, their beneficiaries would receive a death benefit. If you do not take away anything else I'm stressing this evening, take this point away. Life insurance, I submit to you, is more than just to provide a death benefit and an untimely death. It should be utilized in many, many different ways. And when you look at life insurance, you could sort of like put it in different categories. You can say it's going to be a term life insurance, universal life, or whole life. Those are the 3 major types of life insurance. I believe in life insurance diversification. I think that there's going to come a time in your life where you're going to probably have 3 different types of life insurance policies. A term life is really good for individuals who just want to purchase life insurance for a small period of time that's defined. If they have a 30-year mortgage, if the breadwinner were to pass away within the 30 years, well, they want to be able to generate income to pay off that particular mortgage. There is a time that you would probably want to have whole life insurance. And this is an individual who's looking to purchase or a life insurance for more than just a death benefit. This is someone who understands that life insurance could also be an asset because it allows them to accumulate cash value. And this cash value can be used for so many different purposes in your life. So when you're young, this is what I teach my younger clients. And I just did this for my 2 sons. I have one son who just recently graduated from medical school. And my youngest son, he's in his 3rd year. So we are in the process right now doing term insurance that they're going to purchase for themselves. I already have life insurance on them as a mom, but they need to get term insurance right now. The reason why they need to buy term insurance right now as much as they possibly can is because they're healthy right now and the rates are very low. The younger you are, the more term insurance you can purchase for a very, very low amount. The caveat to this is the term insurance policy must be convertible later on without going through insurability, and also gives them the right to purchase more. So that's critical. So if you're young, if you're like in your 20s and you're in your 30s, you can purchase $1 million worth of life insurance that's term for probably like $25 a month. It's nothing. Just make sure that you can convert it later on to whole life. So then after the period of time, you can still have life insurance. The other problem that I see with most people is the only life insurance they have is the life insurance that their company has provided for them. This is okay, but it's not the best, because if you leave or if you retire, that life insurance is going to turn into something you really don't want, that it's not going to last forever. So it's always good for you to have your own life insurance policy that you can control. It's good because the employer offers it to us, but also it limits what it's going to do in the future. There is something.
Dr. Turner, I'm going to ask a quick question for you.
Sure.
So just for the sake of time, so we can get to everything, are there, so you mentioned property and casualty, the homeowners coverage, auto insurance coverage, and we're talking about life insurance coverage. So we have, I know just from the audience, people that are entrepreneurs, as well as those that are, employed professionals. So business owners as well as employed professionals. Are there any insurances? Can you talk about as far as what they should have as an individual, so individual coverage, versus what they should have as maybe a business owner? So are there, life insurance could be across the board, but are there specifics that would qualify for one or the other, depending on, where they are?
Yeah, well, I think it's pretty much going to be based on what their budget is. That's it in a nutshell. Whatever you can afford. If you can't afford whole life, get term until you can afford whole life later. If you can't afford whole life, then maybe go universal life, because that's going to be like the hybrid in the middle. I believe that everyone should start with term and then, invest the difference. And then when the term probably expires, then look at the universal life, look at the whole life and the variable life. You got to start somewhere. So that would be my recommendation for my sons, getting them to start doing this on that particular lane. I cannot give, specific advice because I don't know everyone that's here and all their moving parts, but just generically, I think that that's just very generic advice, and I think you'll be okay with that. If anyone wants, go ahead.
So outside of the life insurance, so we know that whether you are a professional, whether you're a business owner, are there any other types of risk management types of policies that they need to consider? For example, right, there's life insurance, there's disability income insurance. You talked about liability insurance. For a business owner, are there other coverages that they need to take into consideration? Just kind of talk, just hit on what type of coverages should they look at?
Okay, so for business owners, there's something called business overhead and expense. This is if you become disabled and you're not able to work and generate earnings or profit from your company, or if your key man has the same issue, then you could look at purchasing a business overhead expense policy that would pay you a certain amount while you are disabled. I think that that is something that business owners could look at. Also, of course, you would need commercial liability insurance because you wouldn't want anyone to come into your place of business and fall and have an accident, because then you need to sue. So you want to kind of like have that covered as well. When you look at disability insurance, this is very, very important. Most people, they only have the disability insurance that's offered by the employer. I submit to you that you need to have your own policy because of all the moving parts. When your employer pays for the disability policy for yourself and you become disabled, the proceeds that you will receive are going to be taxable. And also there's going to be like an offset, most of them. If you get Social Security, the disability income is going to decrease. Whereas if you had your own policy, right, the proceeds that you receive if you become disabled are going to be income tax free. And it's probably not going to be a Social Security offset with that. My sister was disabled for a short period of time. She filed for the disability underneath her group disability policy, the one that was provided to her by the employer. And she was met with a lot of limitations When she filed for Social Security disability, they limited the amount that came from that group policy. And also the total amount was reduced just because she was only able to get 2/3 of her income minus the Social Security offset. So I think that disability insurance is important for business owners as well as individuals. The other type of insurance is long-term care insurance. The best time to purchase long-term care insurance is when you don't need it and when you're younger, because it's cheaper. But there's many different ways to handle long-term care. You don't necessarily have to purchase a long-term care insurance policy. There are a lot of products out there right now that would allow you to ascertain money in the unlikely event you have a long-term care accident. Personally, I like the hybrid products. I like the life insurance that has the long-term care rider tag to it, because I feel like that money that you receive can be used in any way. If you have a traditional long-term care policy, hear me out on this, guys. The proceeds that you receive, pretty much 90%, must be towards your healthcare expenses. And you and I both know that if you become disabled, you're going to need money not just to pay for your healthcare, but what about your mortgage, right? You know, what about your car note? There's many other things that you're going to need money for. So long-term care insurance, it is a good place. It is a nice thing to have, but just kind of look at the fact that there's different ways that you can receive income to help you if you become disabled.
Thank you so much. I'm actually going to ask Christine a little bit about the insurance and risk planning. Is there anything that you would like to add as far as from Schwab's perspective, how you all approach the risk management planning process with your clients?
Sure. So because of course, some of us, including myself, aren't specific in terms of insurance licensed, we have general conversations within the financial planning process just to highlight or at least identify some of the things that Dr. Turner discussed. So generally, we want to know what is your current situation, what exactly are you faced with right now, that way we can say, go to someone, you know, like Dr. Turner, or go to one of our insurance partners that can actually work with you to identify your unique situation and then to help you to understand the different costs that are available. In regards to the umbrella policy, that's one of the things that we'll, in most cases, find gaps in. This is really just the excess insurance policy for any type of tragic event. We will usually say to clients, ensure at least that you have at least 1 time your net worth. You know, in some cases we'll say 2. It really just depends on, you know, what their employment is, you know, what their career field is, you know, what type of risks that they have either in their home or around them. So those are just some of the things that we'll consider. And, you know, like Dr. Turner said, just look at the different areas. We will make the recommendations, continue to update, you know, those policies and see where we have a gap, and just try not to risk more than you can afford to lose. Some clients like to try to self-insure. Sometimes we'll show them the cost by running a what if scenario. And if you do plan in, always ensure that the person who is helping you with financial planning runs these what if scenarios, because it really takes one event to derail a successful financial plan otherwise. And I heard a story yesterday that really, you know, kind of just sent it home for me. Client was 30, husband was about 32, coming home from the airport, got smashed into his car. He passed away. She was on maternity leave at the time with a 4-month-old baby, and because of all of the proactive planning that her spouse did, she was able to take 4 years off, take care of her child, mourn, and there were insurance policies coming from workers' comp, life insurance from the credit card company, from his employer, to ensure that she was taken care of. And that was because he was young, yes, but of course he took those measures proactively, and his family was able to actually survive even after his passing. So it's important to do it proactively, as Dr. Turner said as well.
Absolutely. And I know there's a lot of information with regards to, I know the insurance risk management planning, it can be overwhelming. And so again, as our panelists have mentioned, it's not going to be the same for everyone, right? So it's not a one size fits all. So we definitely encourage you all to reach out to Charles Schwab, have the conversation with them, reach out to Dr. Turner and retirement planning doctors have the conversation to find out more in depth about what's going to be most appropriate for you, right? So we do have, there's 1 or 2 questions that came in the chat box. So I'm just going to go back a minute for the debt and cash flow management. The question was asked, what is a good method to save the money in an emergency fund? So I'll just go to each one of you if you can provide maybe a method that can provide the audience with to save for the emergency fund, something that you found effective.
Sure, so I'll go first. So for saving for the emergency fund, of course, once you've identified your income and your sources, use a saving account. I always like to say I hate fees, right? If there's any bank that is willing to charge me a fee, I will not do business with you. So especially now where interest rates are very low, check with your local bank. There are many cases where they'll allow you to transfer a minimum of $25 from your checking account into your saving account. And if you do it on an automated basis, there is no fee. I know they have limitations on the withdrawals, but that's because the savings account is for that purpose, to save. So they don't expect you to be making multiple withdrawals. So definitely set up something automated before you know it, especially if it's as you get your check, as it hits your checking account, it's previously scheduled. It's not something you'll forget, and those small increments will over time compound. And if you're earning interest, that will continue to get you to the point where you need to be.
Yeah, I think that's really good, Christine. The only thing I would add to that, I believe in the money market account because it gives you a little bit more liquidity when it comes to, I shouldn't say liquidity, a higher interest than a traditional savings account. So I would probably go to the money market account first, and then once that is saved and you feel comfortable, and then kind of like gradually move over to, there are other products that are out there that are liquid, but it will give you a higher interest in the money market. They're called multi-year annuity fixed products that right now, I just did one for someone and it was coming in at 2.5%, whereas the money market was less than that. So these are other things that are out there that are liquid that will help you once you get serious about saving and building your emergency fund. So start out with your savings account, then go to the money market account, then transition over to a fixed, I'm just generically speaking, a fixed annuity. That's something that you might want to consider.
Thank you so much. Are there any other comments from you all as far as what you are doing? I know some people like to utilize online institutions where they can provide slightly higher yields than a brick and mortar, right? So some people like to do that where it's kind of, they can't just go to the bank, go to the ATM and get money out. They just throw away their debit card and it's, you know, they don't have as easy of access to it. So absolutely.
I see a question. Do most life, disability, and long-term care policies require a health assessment?
Right.
Definitely life insurance does, disability. Long-term care policies are a little bit different. They're more concerned about your mental status. So it's just pretty much a series of questions that they would ask you.
Thank you so much. Are there any questions? We have about 5 minutes remaining. Are there any other questions? Please either raise your hand or you can put it in the chat that you would like to ask on comprehensive financial planning, debt and cash flow management, or insurance and risk planning. I know everyone's probably waiting. See, you're waiting for the good stuff in parts 2 and 3. So everyone's preparing for that. They don't, you know, like kind of the so-called boring stuff. Question. It's boring, but it's very important, right? So,
Right.
One question, is it Awet? You may ask your question. I'm not sure. Okay, their audio may be not working. Okay, so if there are no further questions, what I'm going to do is I'm going to go to Christine and Dr. Turner for final words. What else would you like us to know on any of those categories, on any of those topics, anything that may have been overlooked earlier? Close out with final words. And then also, I know, Christine, you said that Schwab has some information online. So if you can talk a little bit about the services, the assessments, the links that are available, and the resources that Schwab has.
Absolutely. So just to close out, I always like to say action plan, right? Where do we get started? Because that's most important. We can attend as many sessions, as we like and as we have the time to, but we always have to put these action steps into play to actually benefit from that. So number one, definitely pull your credit report. That's your financial identity. This is the one way in which you can actually start reducing your debt, getting a handle on that. And then of course, with that, now you have a summary, you can then start by tackling the highest rate interest debt that you have, and understand all debt is not bad debt. A mortgage or something that will impact your balance sheet positively, that's low interest, it is deductible. Definitely not bad, when we consider leverage, but of course, credit cards, not paying them monthly, paying 30% over time, and carrying that ongoing balance, that can certainly hurt, your financial identity and your long-term goals as well. Another thing to do now that we're getting, for the beneficiaries of either a stimulus or a tax refund, the emergency accounts, if you're not a good saver, maybe set aside a portion of that, put it away into an account that you don't use day to day, something that you can use to start creating that emergency fund. Create your budget, put it in writing. In regards to the resources, Schwab has partnered with the Boys and Girls Club, and we do have a site that's available to the public, schwabmoneywise.com. There are tools and resources. So there are savings calculators, budget tools, spending tools, all kinds of tools that you can use for help. And, this will just, of course, help you to start saving, reducing debt, and then, of course, getting on that path. That way you can be prepared for that next conversation with the investment planning. So that's just really how I wanted to close it out today and tell everyone thanks for allowing us the time today.
Thank you.
Very
Final
good. Those are some really good tools, Christine, that Schwab has to offer. I also have the same tools. If you go to my website, KimberlyTurner.com, you'll find a lot of information that will help you along your planning process. And also on my site, I offer a free retirement financial plan checkup. So go visit the site, and it's there for you, to help you, to guide you. There's no cost whatsoever. And if you want to do an initial consultation with me, I am happy to extend that to your membership free of charge. So go get your free retirement financial plan checkup, meet with me, schedule on my website a 30-minute meeting to get you started.
Okay, thank you so much. So we are right on time. We're at 7:14. So again, thank you to our panelists, Christine and Kimberly. Thank you to Charles Schwab as a sponsor. Again, I can't thank you all enough for the 3-year partnership that you all have had with us. And please, if you have not registered for our parts 2 and parts 3, so that will be the next 2 Thursdays, please do so. And we will have next week, we have investment planning, educational planning, and tax planning. So we have 3 panelists that will be joining us next week, three new panelists for next week. And then the final week, we will have retirement income planning and estate planning. So please make sure that you bring your questions, and we look forward to you